Welcome to the Wednesday edition of the Tech Stocks Daily Podcast. Buckle up, tech enthusiasts, because today is jam-packed. We'll dive into Shopify's amazing earnings report that sent its stock soaring by over 20%. But it's not all rosy. CrowdStrike's latest update fiasco caused global outages and plunged its stock by 42%. We'll also dissect TripAdvisor's disappointing revenue miss that led to a free fall in shares. And lastly, Reddit's astonishing user growth and revenue surge. Everything you need to know about why it's standing out in the social media space. Stick around for an action-packed episode. Oh boy, do I have some sizzling hot tech news for you today. Shopify is on a tear. Shares of the e-commerce powerhouse traded on the NASDAQ under the ticker SHOP have skyrocketed following an exceptional second quarter earnings report and an optimistic outlook for Q3 2024. Let's break it down and see why everyone's buzzing about Shopify today. So first things first, the numbers don't lie. Shopify reported a revenue leap of 21% year over year to hit a solid $2.05 billion, beating the analyst consensus estimate of $2.1 billion. But here's the juicy bit. If you adjust for the sale of its logistics business, that revenue growth shoots up to an impressive 25% year over year. And if that wasn't enough to pop the confetti, their adjusted earnings per share were 26 cents, cruising past the estimated 20 cents. Hitting the glow up button for the third quarter, Shopify anticipates revenue to continue growing at a low to mid-20s percentage rate year over year. They're also expecting a 50 basis point boost in gross margins compared to the second quarter, and are projecting GAAP operating expenses to account for 41 to 42% of revenue. And it's not just about cold hard cash. The enthusiasm dripping from Shopify's leadership is palpable. CFO Jeff Hoffmeister cheered, "We drove strong growth in GMV, revenue, and gross profit, all amidst a mixed consumer spend environment." And folks, he wasn't wrong. Gross merchandise volume bumped up 22% to hit $67.2 billion, proving that the underlying business is as robust as ever. Plus, gross payments volume saw a significant hike from $31.7 billion to $41.1 billion, meaning more transactions are happening on Shopify's platform. And for those keeping score at home, the company also dialed up its free cash flow from $97 million to a jaw-dropping $333 million. Talk about securing the bag. Adjusted EPS also jumped from 14 cents last year to 26 cents, knocking it out of the park compared to the consensus at 20 cents. Even on a generally accepted accounting principles basis, Shopify was profitable with a net income of $171 million or 13 cents per share. Investors seem ecstatic about the future projections too. Shopify forecasted revenue growth in the low to mid-20s percentage rate and aimed for a 50 basis points improvement in gross margins. They also expect free cash flow margins to remain strong and are planning considerable marketing investments to keep the growth engine revving. Market analysts from JP Morgan even threw in their 2 cents, lauding Shopify for smashing that important 20% revenue growth line while expanding profit margins. Even though there was a modest sequential deceleration in GMV and GPV, the fact that monthly recurring revenue surged by 12% sequentially highlights that the company's strategies, whether price hikes or new additions, are hitting the mark. So no surprise here, investors couldn't wait to buy in on the good news. Shopify shares surged by over 20%, ticking up to around $65.31. It's clear, Shopify's future looks as strong and vibrant as a fireworks show on the 4th of July. And that's why everyone's talking about Shopify today, from Wall Street to Main Street. Welcome to today's Tech News Rundown. If your popcorn supply is up to par, you're in for quite a saga, all revolving around one name, CrowdStrike Holdings, Inc. Get comfy, because this cybersecurity giant is facing the kind of drama that would make even Hollywood blockbusters jealous. First up, a timeline to keep you in the loop. Just within the last 30 days, CrowdStrike stock has nosedived by a gut-wrenching 42%. What caused this financial roller coaster plunge? Well, on July 19th, the company rolled out an update to its Falcon cybersecurity platform. Instead of making things more secure, the update led to global system outages affecting over 8.5 million devices running Microsoft Windows. Efforts to fix the issue quickly proved futile in the face of the major damage already inflicted. The ripple effects were nothing short of catastrophic. Large companies, including Delta Airlines, experienced massive service disruptions. Delta, for instance, reported losses amounting to $500 million due to a 5-day service interruption that grounded planes and threw travel plans into chaos. The disruption's overall financial footprint is estimated to reach a staggering $5.4 billion. There are multiple class action lawsuits crashing down upon CrowdStrike like a storm. In not one, not two, but 3 major announcements, law firms including Bronstein, Gewurz & Grossman LLC, the Gross Law Firm, and Robbins, Geller, Rudman & Dowd LLP have all invited CrowdStrike investors to seek leadership roles in these lawsuits. If you happen to be a CrowdStrike shareholder, September 30th, 2024 is the date to circle on your calendar. The accusations against CrowdStrike are severe. The primary grievances allege that top executives issued misleading statements and failed to disclose material information about the Falcon platform's readiness and testing protocols. The disastrous update revealed deficiencies that could expose CrowdStrike to devastating reputational and legal risks. According to the various lawsuits, these failings translated into an artificially inflated stock price, setting up investors for massive losses when the truth came to light. Adding further layers to this tense drama, Congress is now involved. They've called on CrowdStrike CEO George Kurtz to testify about the crisis. This, on top of the flurry of downgrades from analysts like Guggenheim and BTIG, only doubled down on the stock's freefall, down by 13% and another 10% on consecutive days when these updates were announced. So, what does the future hold? While CrowdStrike is a massive $55 billion entity holding a formidable position in the booming cybersecurity space, its recent faux pas might make it lose some trust among enterprise clients. Competitors like Palo Alto Networks and SentinelOne are probably sharpening their knives, eager to swoop in and convert pretty much anyone who has serious trust issues post-outage. Despite this, some are still holding on to optimism, eyeing CrowdStrike's robust financial metrics, like its solid operating income and high gross margins. Yet the challenge remains massive, and the reputational scars aren't going away overnight. As such, savvy investors are preparing for a volatile journey ahead, likely with more dips before things level out, and that lofty price-to-earnings multiple starts to look more digestible. Stay tuned, folks. This tech roller coaster is far from over. Get ready for a bumpy ride, because TripAdvisor stock has taken quite the tumble today. I'm talking about a multi-story roller coaster dive, folks. Let's break down why TripAdvisor has been making waves, and not the good kind, on the NASDAQ. All right, so TripAdvisor released their second quarter 2024 earnings report, and it wasn't pretty. First off, although they managed to top the adjusted earnings per share expectation by coming in at 39 cents versus the forecasted 37, their revenue wasn't up to par. They reported $497 million in revenue, missing the analyst consensus of $504.8 million. To put that in perspective, that's like promising a luxury cruise and delivering on a budget ferry. No wonder analysts are disappointed. Dive into the details, and things get even murkier. Despite an overall revenue boost of 1% year over year, individual segments told very different stories. Their Viator segment, which focuses on tours and activities, showed solid performance with a 13% revenue growth to $244 million. On the flip side, their core brand, TripAdvisor branded hotels, slid backwards, dropping 10% in revenue to $250 million. You win some, you lose some, right? But here's where it gets gnarly. Adjusted earnings may look cheerful at first glance, but a deeper dive reveals GAAP earnings of just $0.17 per share. No growth compared to last year? Not a good look. Add to this a nearly 60% decline in free cash flow, which plummeted to $37 million year over year, and you're starting to see why investors are rushing to abandon ship. Wall Street wasn't feeling optimistic either. Analyst reports came flowing in like stormy seas following the earnings announcement. Not one, not two, but 5 analysts reduced their price targets on Trip stock. It's now rated under a cloud of skepticism. Only one analyst dared to label it a buy, while 2 flagged it as neutral, and another 2 waved the dreaded sell sign. It's like a critical judge panel at a talent show, and TripAdvisor didn't make it past the auditions. TripAdvisor's own guidance added insult to injury. The company indicated that its revenue might be flat to even down in the third quarter, with profit margins set to shrink by about 350 to 450 basis points year over year. Talk about hitting them where it hurts. The skepticism around their future performance only makes matters worse, especially when you consider that the stock is priced nearly 100 times its earnings right now. So, to sum it all up, TripAdvisor's sky-high expectations have been grounded. Between the lackluster revenue growth, the concerningly flat earnings, and analysts' collective cold shoulder, it's no surprise that Trip shares plummeted about 11% and traded down more than 14% in pre-market. If you're wondering whether this stock is a buy or a fly-by-night, today's news made it pretty clear for most experts. It's a rough ride ahead. Stay tuned, because this story is far from over. Hey tech lovers, buckle up, because today it's all about Reddit crushing it in the tech sphere. If you've ever wondered how an underdog in the social media game can shake things up, Reddit's got your answer. This is the new Cinderella story of the digital age. First up, Reddit made headlines with some exciting data about user growth. While other social media platforms like TikTok are losing their mojo, Reddit's daily active users are skyrocketing. The platform reported a spectacular 39% increase in desktop and mobile web visits year over year in May. With 342 million active users and counting, it may still look small compared to Meta's colossal 3.3 billion user base. But hey, Rome wasn't built in a day, right? One of the drivers behind this growth? Reddit's genius move of positioning itself almost as a search engine. People are running a staggering 1 billion search queries a month on the platform. Google even upgraded its search to include more Reddit results. After all, what's better than learning from the lived experience of fellow netizens? And let's talk numbers, because we love them, don't we? Reddit's revenue shot up to $281 million this quarter, a 54% year-over-year increase, fueled mainly by advertising and intriguing licensing deals with OpenAI and Google. CEO Steve Huffman certainly didn't hide his excitement in the earnings call. Reddit is steadily aligning itself as a must-visit space for users keen on exploring their interests, not to mention catching a slice of Google's and OpenAI's innovative cakes. But everything isn't just sunshine and rainbows. Reddit's decision to tighten the reins on content access, particularly slapping Microsoft's hand away from freely gobbling up its data, put them squarely in the headlines. Huffman's got a badass motto here: We want to know where Reddit data is going and what it's being used for. Who can argue with the importance of data transparency and privacy? This move might sting for anyone using Microsoft's Bing, Anthropic, or Perplexity, but Reddit continues to offer its juicy content for free for non-commercial use. Financial analysts can't get enough of Reddit either. Analysts are raving about Reddit's partnerships with big names like OpenAI, Sprinkler, and Google. Add better than expected revenue figures and improving EBITDA margins to the mix, and you've got investors clamoring to buy into Reddit's future. The stock has had its ups and downs, closing at $54.36 and then taking a dive both during and after terms of trading. Yet, the general consensus is that Reddit is executing exceptionally well. So what do you guys think? Is Reddit poising itself to become the breakout star of the social media world? Should more platforms follow Reddit's example in terms of data management and user growth strategies? Spill your thoughts in the comments below. We can't wait to hear what you have to say. Remember, those upvotes aren't going to click themselves. Go on, show this video some love. Let's zoom in on Shopify, the e-commerce juggernaut that's trading on the NYSE and not the NASDAQ. But hey, tech is tech, right? With their recent performance and all the buzz, the burning question is whether you should buy, sell, or hold. So Shopify just unleashed a stunner of an earnings report. Can we talk about that 21% year-over-year revenue climb to $2.05 billion, which doesn't even account for the stellar adjusted 25% after selling its logistics business? They're also totally owning it with a sizzling 26 cents adjusted earnings per share, smashing the analyst expectations. It's like Shopify has gone into beast mode. They're doing all the right things, like driving growth and improving gross margins. Their outlook for Q3 2024 is just as sunny. They're setting the stage for a potential encore performance with low to mid-20s revenue growth. Plus, with $67.2 billion in gross merchandise volume, it's clear people are shopping up a storm on their platform. However, a 20% spike in share price can make anyone a bit jittery. Could be some froth there. Still, CFO Jeff Hoffmeister and the Shopify team are channeling Oprah energy. You get growth, and you get growth. Consistency in free cash flow surge, hitting $333 million, suggests a robust financial safety net. All right, personal take here. I'd say buy. The fundamentals look juicy, the company is optimistic about future growth, and that cash flow and positive EPS streak is like the cherry on top. But remember, folks, diversification is key. Shopify's at an all-time high. Buying could be riding a rocket, but rockets can come down too. Always do your own due diligence. Dive into those financials, read up on broader market conditions, and judge based on your risk tolerance. Because while we're having fun, responsible investing is no joke. Today's market was a wild ride. Shopify stunned with a rocket-fueled earnings report, sending shares soaring over 20%. However, CrowdStrike faced a crushing blow with ongoing class action lawsuits and a stock plummet, while TripAdvisor's lackluster earnings report left investors sinking. Reddit, on the other hand, came out swinging with robust user growth and revenue spikes, stirring excitement. If you enjoyed today's roundup, hit that like button, subscribe for more daily tech updates, and share this video with your fellow tech enthusiasts. Don't forget to tune in tomorrow for another action-packed summary.